In this video, uh, we will look into different type of securities. The learning objectives is to see that what are the characteristics of these securities, how they are traded, how they are quoted in the press, or the platforms, the financial platforms over where they are traded. So these securities are the interest bearing assets. For example, bonds. They give the periodic interest payments, which are also called the coupon payments. Then we also look into the equity securities, which are stocks. We will look into the future contracts and option contracts. They are derivative because they drive their value from some underlying asset. And we will also see that how the investment in these assets, which are the derivatives, futures, and options, can be very risky, although they were actually designed to manage the risk. So the goal in this chapter is to introduce the different type of securities that investors routinely buy and sell in the financial market around the world. And knowing their characteristics is very important, and what are the potential gain and losses associated with them is very important. So if you see that under the interest bearing securities or assets, we have two subdivision, which is called money market instruments and the fixed income securities. The usual difference is this, that the money market instruments are the short term debt, normally within 1 year, and the fixed income securities can be up till 30 years, or even it can be more than that, right? So anything which is beyond 1 year, it is usually called the fixed income securities. And why they are called fixed income? Because there is according to a predetermined schedule, they keep giving the interest payments or coupon payments. The equities are common stocks, like the stocks usually traded on the in the exchange. And then there is an also hybrid security, which is called preferred stock, but it comes under the equity. So some of the characteristics of the debt is present in the preferred stock, and some of the characteristics of the common stock is present in the preferred stock, and we'll look into it in next few slides, after a few slides. Then finally we have derivatives, which is the futures and options, and which again, as just I mentioned, they drive their value from some underlying asset. It can be anything. It can be bond. It can be the exchange rate. It can be the stock. Obviously, it can be even any agriculture product. And so these contracts are traded on that, on those things, and we will see that how they actually work. So money market instruments, as I mentioned, are short-term debt, and these are obligations by the corporates and the corporations, large corporations, and the governments. And as I mentioned, usually their maturity is 1 year period of time. So these are the money market instrument, and they usually make one final payment, which is actually the face value. And in that face value, the interest is already present. In case of fixed income securities, these are long-term debt, beyond 1 year period of time, and according to a predetermined schedule, the interest payments keep happening, and finally at the maturity, the last interest payment happens, and the face value is also given back to the investor. So first we'll talk about the money market instruments. The example is the US T-bills, bank certificates of deposits. So usually their age or the maturity is 1 year period of time. And what are the potential gain? The gain is that there is a known future payment. So you are sure about that what future payment you will get. That will be the face value. You'll get that, right? And only in case if the borrower defaults, which is for the large corporations or the government, this is very unlikely even to happen. So the investor will not be able to get the money. But again, it's very unlikely that a government can default on its on the payments, or the a big corporation can default. So how the prices are quoted? So for example, the face value is the $1,000. So this is the final payment you will receive after a year, and 10% is the interest rate. So they are quoted then at discount value. So simply you need to divide 1000, just pause over here and divide 1000 by 1.1, right? So zero point 0.1 suggesting 10%. So you will get $909.09. So an investor needs to pay $909.09, 909.09 today, and after a year, he'll get 1000 in face value, and that will be a one time payment. And 10% has added into it, which made it to 1000. So 10% of 909.09, which you have paid, is will be added into this original payment, which eventually make the overall payment of 1000, which is also the face value. So they are traded or sold on the discount basis. Only the interest rates are quoted over here, which is 10% in our example. Therefore, investor must be able to calculate prices from the quoted rates. So if someone will say simply that 1000 is the face value and the rate is 10%, so you simply need to know that 1000 need to be divided by 1.1, and this will give you the face value. Sorry, this will give you the price which you need to pay. The face value was 1000. This is how the money market instrument is quoted. Now let's move to the fixed income securities, where the maturity is more than 1 year period of time. Over here, the face value is the price, right? Which if the bond is getting floated for the first time, face value you have to pay, and then according to a predetermined schedule, after every 6 months, usually the coupon payment is made. So, for example, if there is a 5 year bond and its face value is 1000, or this is the price which you are going to pay 1000, and the coupon payment is 5%. So, what is the 5% of 1000 for a year? So, it's $50, right? After 6 months, the you will get $25, and then further 6 months you will get $25. So in the whole year you will still get the $50, but the first payment you will get after 6 months. So $50 will be divided by 2. This 5%, again I'm telling you 5%, which is 0.05, multiplied by the face value 1000, and this will determine the interest payment of 1 year, which is $50. And this $50 will not be paid in one go. It will be paid in 2 installments. First payment will come after 6 months, and then further 6 months it will come $25. So $25, $25. You add them together, you know the maths, it's $50. And then the second year, again, in the second year after 6 months, another $25 will come, and then another $25 will come after 6 months. So how many 6 months are there in 5 years? 10. So 10 multiply by 25. So total interest payments will happen $250 on the face value of $1000 bond in the 5 year period, given the interest rate or the coupon rates, not interest rate. This is the right word. Coupon rate is 5%. Now, the this is important to remember, that let's suppose if after 1 year I initially invested in the bond when it got floated, and the face value was 1000, and the coupon rate was 5%, and coupon rate was determined uh, as per the interest rate in the economy when initially the bond was traded. And after 1 year, initially the maturity period was 5 years, and after 1 year I thought, now I have to sell it. The price of the bond at that time will then depend on the interest rate in the economy at that time. That the similar bond with the similar rating, similar maturity, at what interest rate or what coupon rate they are actually getting floated. If the interest rate will decrease and my coupon rate, the bond